Now, if you do, right, next up, if you do get a question on bank regulation, this is also the 2019 paper, you'll also be spending a bit of time on behavioural economics. Right, so let's start off with the Keynes quote. If banks behave like casinos, then they will do poor business. It'd be a job which is badly done. Now, in effect, in 2008, 2009, or prior to that moment in time, banks were acting like casinos. Okay, so that's the first thing. Systemic risk. It could bring down the whole banking system if one firm goes under, but it could also bring down the whole of the real economy. So therefore, the government will come in and help the banks out. They almost have to do that. And there's an example there of moral hazard, is because banks are too big to fail. What this means is banks are willing to take risks because they know that if they go down, then the government will come in and help them. So if you're in your own business and you take a big risk, then that's your problem. The business goes under and you will lose all your money. But in this case, they were bailed out by the government. Okay, so the 2008-2009 financial crash, this was a major event, did lead to a fall in demand and did lead to a recession of about 6% of GDP. And as we all know, the government moved in. First of all, it came in with fiscal policy, increasing G, and next up, 10% budget deficit, and next up it also came with some quantitative easing, where they brought up all the bad bonds of the banks. We've also got here the herding effect, is that people get more and more excited, so everyone wants to borrow money to buy a house. And we also found irrationality, is that not even the people who run the banks understood all of their sophisticated financial instruments, etc. Okay, so how would we write an essay on this? Well, probably the key essay is, should we have more regulation or less regulation? Right, para 1, talk about the cash ratio and the capital ratio. If you reduce the cash ratio, then the banks can lend out more money. E.g., if the cash ratio is 0.5, which meant the banks have to hold, for every pound they lend out, they have to hold 50 pence, then if you put in £1,000, you'd only get £2,000 out, according to the credit multiplier. If the banks have to hold 10% of the money, 10% of the money in cash, then they can lend out, if you put in £1,000, they can then lend out £10,000. However, some banks before the financial crash had a cash ratio of 1%, which meant they have 1% cash and they would lend that out 100 times over. Now that is making much more likely that there will be a financial crash. So we've also had the capital ratio in there, which really determines how much the bank can raise through shares, which means the amount of money that the banks can lose before their assets are worth less than their liabilities. Okay, so we've still got these other concepts in here. Talk about moral hazard, talk about herding, talk about bad irrationality. Para 1. Para 2, systemic risk. Talk about that. It can bring down the real economy. It can bring down, not only can it bring down the banking system, but if we don't have a banking system that works, if they lose all their money, then it can bring down the whole economy. The whole idea about banks is that they take in savings, right, and they lend out for business investment, which clearly then will increase the AS curve. That is what they should do. They should not be acting like a casino and lending out loads and loads of money and speculating on loads of things, so therefore that they can make even more money, so therefore people want to go and work in banks and all those sorts of arguments. If they act like a casino, they're not serving the economy. They may be making loads of money. Okay, they make loads of money. Then we get loads of taxation revenue. But if they get it wrong, it can bring everybody down with it. So paragraph 3 is really about, well, if there's too much regulation, then the banks will stop lending money out. And maybe that will, if they don't lend out enough money for investment, don't take enough risks, then that would affect the whole economy. And at what level should the regulation be at? And look, no one knows. It's a really complex question, so I would probably argue that right now they probably got the regulation just about right. Okay?